Our next guest is Rahul Singh, who's Chief Investment Officer Equities at Tata Asset Management. Rahul, it's great to have you on the show. Thanks very much for taking out the time. Kind of portfolio strategy are you adopting in this market? From the volatility we witnessed, it seems like, and maybe it's early days, that the markets may have entered into a bit of a stable zone amidst an uncertain global environment, given the benefits one is to receive from a macro perspective on the rebound in the rupee as well as the falling crude. Do you believe that that would be the case? That would be the near-term trend, sideways to stable at best?
Yes, hi, good morning. Very much so, because what the risks were emerging in the political scenario has been balanced by the decline or the appreciation of rupee and decline in crude. So to that extent, there is some kind of a balancing factor which has come in the market, and that is obviously helping valuations and markets stay where they are. So our focus really is on selecting the themes and sectors which we think are positioned well for a good 2019, rather than worrying about the broad market levels. So among other sectors, we like corporate banks, we like parts of the industrial capex cycle, and just to name a couple of sectors which we are focusing on. So in terms of the macro, I think the scenario is pretty much going to be very similar over the next 3 to 6 months. What I think is important to watch is what kind of expectation gets built in the US in terms of how fast the slowdown expectations build up and what it does to the Fed rate hike expectations. So already we are seeing some talk of a pause after another 2 to 3 hikes. So that's a positive from an emerging market point of view, and that will also feed into India at some stage.
Right. Rahul, wanted to understand, when you say corporate banks, I'm assuming that, you're leaning towards ICICI Bank. Do you not believe that it's a crowded trade? Although some contrarian views are also that, while out of the 50, 49 analysts in the street are bullish on ICICI Bank and they believe it should be bought, no one's actually going out there and buying ICICI Bank.
Yes, that's correct in a way, but I think what needs to be seen is that this sector as a whole, or this pack as a whole, is coming off last 3-4 years of significant underperformance vis-a-vis retail banks, and some of these so-called corporate banks have built a fairly sizable retail presence as well during this period, which has gone unnoticed. So why we like this pack is not only because we think the credit losses are going to come down, which is now a consensus view, as you rightly said, but also because given the dislocation in the financial markets which we have witnessed in the last couple of months, we see that there is a pricing power coming to the wholesale bank or the wholesale lenders on the banking space, given what we have seen in the NBFC space. To that extent, I think even the NIMs, which we have been all worried about the entire 2017, that the NIMs might decline because of higher interest rate scenario, that could reverse in 2019. So we will have a double benefit of stable to marginally going up NIMs and falling credit costs, which means there is a potential for earning surprise in these banks, and they are not expensive. As you mentioned, there's not been a big enough rally for these stocks to make them expensive relative to the retail lenders.
Okay. How are you looking at the trade rationale or investment rationale for IT and pharma? Two stories very closely linked to the currency. In the fall, they of course saw a bit of a bump up, especially IT. Do you think that with the strength the currency is showing, there would be a reversal?
Well, actually, currency was the wrong reason to buy IT because and pharma, because most of the currency related gains are, does not really flow through to the margins because the costs have also become very, very dollarized. So the companies have been saying it, but still the market had viewed this sector as a currency play, which in my view is not really correct. So to that extent, I don't really see currency as a big dampener. I think, as I was mentioning earlier, the US slowdown and what it does to the corporate spends and the IT budgets there needs to be watched much more carefully. So at this point of time, IT is in a bit of a wait and watch space, and therefore within the portfolios across our funds, we are typically underweight and staying with the larger companies and not really going down the chain and buying mid caps.
Right. Wanted to understand then, Rahul, how is it that you're approaching this entire crude cool-off? Some believe that OMCs and even aviation to that degree can be bought. And we all know that across the segment there would be that raw material cost saving as well that most companies would incur because of the cool-off in crude prices. What is it that you're particularly keen on as an investment when it comes to the crude sensitives?
Yes, in terms of the decline in crude, it obviously helps a lot of sectors, apart from the sectors you mentioned, even sectors like paints and some of the other consumers of crude related derivatives. So that is a very wide kind of a benefit which comes. The most obvious ones you mentioned, the oil marketing companies and aviation. On the oil marketing companies, I think in an election year, the government would be probably much quicker to pass or let the OMCs pass on the decline in crude prices to the retail prices. So we are not that optimistic on how much of this decline in crude can be retained by the oil marketing companies in terms of their excess margins. There is also a risk of reversal in the excise duty cut, which we saw recently, because there are the fiscal deficit also needs to be kept in mind there. On aviation, it looks slightly more interesting because not only because of crude, but also because the sector itself could go through some consolidation. Because there are players in distress, large players in distress, which could fold up into smaller players. So the industry structure of aviation could change 6 months down the line, and that makes it a little bit more interesting than oil marketing companies to play stable or low crude.
Okay, just about a minute to go before we hit the pre-open rates. I want to quickly mark the top 5 factors to watch. Apple drags the Dow, but it's still a respectable close for Wall Street. Asia is largely upbeat this morning, so that's something to take heart from. The cues we were handed with as far as the Brexit deal goes also seem, largely confidence-inducing, so to speak, this morning. NBFCs fire up in the last hour, top sectoral gainers in yesterday's session. Is this a turn in sentiment when it comes to buying NBFCs? A couple of more days of keeping them on the watch list would give us some sense of whether or not there's a conclusive trend in the making there. Reports are indicating the Reliance Industries is mulling listing a retail arm in 2019. So again, the spotlight would squarely be on Reliance Industries this morning. CLSA says investors eyeing Maruti and Eicher on declines. If there's some rationalization in valuations there would be a case to buy these stocks at lower levels. And then rise with India, India to overtake Brazil as a top sugar producer will clearly benefit sentiment on sugar stocks. Let's open the markets. At least the pre-open rates are indicating that we are in for some bit of a positive bias. I don't know sustainable or not. You're looking at the rupee now closing into a 71 level, 71.13 coming in for the currency as we speak, and I think that's a very encouraging sign. Rahul, do you believe that the currency will only go from one point of strength to another, that this is a meaningful reversal?
No, actually, if you look at all the currency moves in the past, whenever there has been a spate of currency devaluations, it goes to a level that retraces back and becomes stable. So we are, I think, searching for that level between 70 and 72 in my view. So if you remember 2013, we went up to 68, 69, then stabilized between 63 to 66 to a dollar. So currency markets have a tendency of having a stable 2 years and then a steep depreciation in the third year or fourth year. So that is what is happening. I see that the currency will be stable around these levels. Exactly which level, obviously is very difficult to say, but if you look at 3 to 4% annual depreciation rate every year, it broadly indicates that these are the kind of levels where it will become stable. And I don't see a tailspin kind of a scenario which was developing in 2013, because at that point of time we had much higher current account and fiscal account deficits. That is no longer the case. So we are obviously looking at a more stable macro parameters, and therefore any decline in crude is directly flowing into, and commodity prices is directly flowing into stability of rupee. So I think we will probably find stability in rupee much faster than we found it in 2013.
Is Telecom, Rahul, worth a relook? You had Bharti on the sidelines of its analyst call say that ARPUs have bottomed out. Just yesterday, Vodafone is saying that the management is, the firm is well funded and that they aim to achieve Vodafone synergies by FY21. They're saying 25,000 crore rupee equity is more than external debt, and they're looking at fundraising as well in the next 12 odd quarters. Also, we've seen some sporadic moves come in both Idea as well as Bharti as well. The stocks have been a little jumpy of late. Is there an investment case here?
If you take a 3-year view, there is an investment case building in the sector. There is no doubt about it. But it depends on in the timing of the inflection point, and when the recovery starts to happen in ARPUs remains very, very difficult to judge, because it is dependent on the market share aspirations of the challenger, which is no longer a challenger. I mean, they own 23-24% share now. I'm talking about Jio. So basically, the aspiration of on the market share, whether it stops at 30, 40, 50, is very, very moving target in my view. And it is also dependent on how well capitalized or how well the incumbents are able to fight back. So there will be some equilibrium at some stage. I think we are probably maybe 6 months away from that equilibrium, maybe 9 months. So in this period, you will see the stocks obviously reacting to small bits of news on tariff hikes or tariff cuts, or funding, or capex, etc. So I would say that in 6 to 9 months is when you will probably see an equilibrium in the market in terms of the market share dynamics, and that really will drive lesser aggression from the challenger, and therefore a lift in the ARPU from there on. So we could use this 6-9 month period to keep evaluating and keep looking at building exposure in this sector on dips.
Okay, fair enough. Give us your view on commodities and how you're positioning yourself among base metals. Hindalco and Tata Steel have enjoyed multi-year bull markets over the course of the last 2 years. I would imagine the rally has been fairly strong. Time to take profits off the table?
We are underweight on this sector, basically from a very macro top-down view. If you're looking at a global slowdown taking shape in 2019, the case becomes much weaker for commodities in general. And right now, some of the names which you mentioned are enjoying very high EBITDAs per ton, historically high EBITDAs per ton. So we are very cautious on that segment, also because they are much more global plays and plays on how China economy does and so on. So it's not really something which is looking extremely positive right now.
Okay, here's S. Krishna Kumar, Head Equity at Sundaram Mutual Fund, who believes that markets will see a relief from oil and currency volatility. He remains positive on private corporate banks as well as capital goods.
We would like to be in the corporate banks from the private sector, and definitely a couple of them have seen management changes. Good people have stepped into the senior management, and a lot of cleanup has happened in terms of provisioning. I think they are stuffed with good capital, so they don't need fresh dilution for growth. They remain the private sector retail-oriented banks remain compounders, but the alpha definitely would come from these private corporate lenders. We've been increasing our exposure to the private sector corporate banks in a significant manner across the large and the diversified funds. We also have been trimming some of the NBFCs which have been hit by rising interest costs. On the other side, I think we do believe that the investment cycle in India is at a nascent recovery phase, and we should be looking at adding a lot of the capital goods, light engineering, short cycle capex plays at this point in time. We already have seen industrial consumable companies and others do very well.
Okay, let's get you a quick recap then of all the stocks which are in focus this Thursday morning. And Reliance's retail arm, it seems, is going to be listing. At least that is what the reports are indicating, that they're mulling listing their retail arm in 2019. CLSA has come out with a note on autos. They're saying M&M is positive in tractor demand. Motherson is going to ramp up expansion plans, and that investors are eyeing Maruti as well as Eicher on declines. Jet Airways, and reports indicate that Etihad is now in talks to increase stake. Also on the sidelines of the analyst meet just yesterday, Vodafone Idea, the management is saying that the firm is well funded. They aim to achieve Vodafone synergies by FY21. So that's another stock that you need to keep on your radar this Thursday. GAIL India, the government is looking to launch city gas distribution bidding. The company is going to be serving as a feeder source for 3 cities. So look out for this one. This is going to be an important one.
Few more stocks from futures and option segment. Federal Bank, now this stock added decent amount of long positions in yesterday's trading session, and we have been seeing consolidation, and after breach of some resistance, the stock can probably move higher. 10% rise in open interest with rise in price in Federal Bank, which is positive. Now after 1 month of consolidation, the stock is poised for a breakout, and it's quite likely that it may happen. If you look at the levels of 84, 85, that's where stock has taken resistance, and the way built up is taking place, the way volumes are there in Federal Bank, it seems that there might be a breakout, and our technical experts were also suggesting to buy this stock in previous trading session. So watch out for Federal Bank. The other stock is from two-wheeler space, and in opening remarks of the show, we were talking about two-wheeler space and how they are not performing that well. Yes, Eicher is showing bounce back, but Bajaj Auto in yesterday's trading session saw 5% rise in open interest with fall in price. Needless to mention that these are short positions which are getting formed. Volumes were high in both the segments, and 2700 level has emerged as a strong resistance. So watch out for Bajaj Auto. Negative observations over here, positive observations in Federal Bank. When it comes to index trades, our experts remain bullish, but they have just toggled their index trades. Yesterday we had CK bullish on Bank Nifty, today is bullish on Nifty. It's a positional trade for Manas, but then CK's Bank Nifty trade is 26,550 is his target price, and 26,100 is the stop loss. Seems to be an 1 or 2 days trade. Manas is now bullish on Nifty with a target price. That's interesting because he had a target price of 10,900. Now target has been revised downwards, 10,750, and stop loss is 10,530.
Okay, just about 5 minutes to go before we hit the actual rates for the day, and we'll know how the markets have opened the session. Rahul, I wanted your perspective on where you would want to be contrarian in this market. There was just news about the sugar space, India turning out to be the largest producer of sugar. Do you think agri-commodities is a segment where there could be some traction?
Yes, I would actually. That's a good sector you highlighted, because one would not only look at the domestic agrochemical, but the global agrochemical space in general has been going through a very slow or a lackluster period over the last 2 to 3 years. So that itself, there are early signs of revival. So and the stocks have seen a sideways correction or a downward correction over the last 2 to 3 years. So they never participated in the rally also in 2017. And they have outperformed this year, but that's also because the rest of the market has come down. So they are at a point where the earnings have started to look up finally after last couple of years. There is demand and inventory correction which has happened in the global markets, and some of the companies in that space look extremely interesting.
Rahul, good to have you on the show, and thanks so much for taking the time out and joining in. Then we a quick recap of the top 5 factors.
Oh yes.